the Dow closing in on 20,000, let's think back to Dow 10,000. Remember that? Now, it broke the level initially in 1999, but hit it again in 2010. Could the Dow be set for what could be another lost decade once we hit this Dow 20,000 number? Welcome to Trading Nation. I'm Brian Sullivan. Craig Johnson of Piper Jaffray and Mark Tepper of Strategic Wealth Partners are your guests today. Mark, I guess the point is just because we break through something once doesn't mean that the market then won't take a tumble. In some cases, a big-time one. Of course, we did the financial crisis. Do you think it's possible that we could hit Dow 20,000 and then hit it again in a decade, and not in the way that you want?
No, I don't think it'll happen. I do think that over the course of the next year, I do think we're going to hover right around 20,000 for quite some time. But I think once we finally and ultimately break through, our projections for U.S. large cap stocks are a little over 5% annualized over the course of the next 10 years. So, absent some sort of a severe financial crisis, I really wouldn't see that happening. But again, kind of going back to what I see happening over the course of the next year, since Election Day, the Dow is up like 9%. And when you look at 2017 earnings estimates, we're looking at 7% growth. So my concern really right now is how much of that future growth from 2017 has been pulled forward as gains that we've experienced in 2016.
Well, answer that. How much do you think?
I don't think we're going to see much of anything next year, unfortunately. And one of the reasons for that is over the course of the last 5 years, much of the gains in the market have come from multiple expansion. Now that the Fed has really committed to beginning and continuing through this tightening process, multiples typically at this stage don't continue to expand. So in order for the market to continue to produce gains, we're going to have to see that come from profit and earnings growth.
Yeah.
And I think a lot of that's already been pulled forward. So I would expect a pullback, and then some additional gains and maybe finish at the end of next year slightly above 20,000 on the Dow.
Okay. Craig Johnson, your view?
Well, Brian, we're a little bit more optimistic than that. From our perspective, we don't think that this is a market that's stalling out or going to hit 20,000 and then stall. From our perspective, this looks more like what we've seen in the early 1980s and the early 1950s. This was the kind of early stages of this secular bull market. And a couple things I would point out. First, number one, when you go back and you look at when we first went through 10,000, it only took 5 weeks for us to get to 11,000 on the Dow. If we go back and look at 15,000, a similar type scenario, you made it in about 26 weeks. If we hit Dow 20,000 in the next day or two, this will be the fastest 1,000 points we put onto the Dow. Why is this happening? Number one, in Washington, we're finally moving out of this monetary policy to more of a fiscal-based policy. I think that's a huge sea change. We're going to get tax cuts next year. Earnings estimates, they're all too low. They're going to have to come up. And from that perspective, I think we still have a nice move ahead. We're still looking for 2350 end of this year. It's going to be tight, but I'm holding on to that bet for now. And for next year, I'm looking for 2424 on the S&P 500. And I think that could actually maybe even be light as you look forward into 2017, given all the stimulus is coming into this market. The Fed, still very accommodative at this point in time, and we're still well below historical rates. And then lastly, Brian, I would just mention, as we start to see interest rates come up, signs of the economy is getting stronger, I would just very simplistically say the rotation out of fixed income into equities is going to be a real driver for stocks, and it's going to push this market longer and farther than people think. All
right, a much more optimistic view from Piper Jaffray. Mark's a little concerned we're stealing from the future today. Guys, we do appreciate your views on Dow 20,000 and beyond. Craig and Mark, thank you both very much. Well, since the Dow first hit 10,000 in 1999, not every Dow stock is higher. Can you believe that? GE, Pfizer, and Merck actually all lower in that time. Could any of these stocks now make for attractive buys? Mark Tepper of Strategic Wealth Partners, Craig Johnson of Piper Jaffray are your guests. Listen, GE had its own issues with GE Finance. Craig, Merck and Pfizer, we know the big pharma growth has really slowed down. Biotechs have taken a lot of the attention. Do you think any of these three names are sort of either undeserving of what's happened to them and thus then deserving of our viewers' new money buying them now?
Well, Brian, just purely based upon the charts, you look at something like Pfizer, you're still about 44% below where you were in March of 1999. I mean, when you speak of dogs of the Dow, this has clearly been a dog at this point in time, and so is GE, and we continue to think that these names, there's better places to be than these three at this point in time. I'd also just point out that Merck and Pfizer in the healthcare sector, just want to remind the viewers that healthcare is traditionally a defensive sector, not an offensive sector. So I'm not looking for a lot of catch-up in these names right now. I'd rather be buying tech, I'd rather be buying energy, and also basic material names, Brian.
Okay. Mark Tepper, Pfizer, Merck, GE, any of those you like?
Yeah, we like Pfizer. We do own it for clients. It really fits the profile of what we're looking for from an investment perspective. So, number one, it's undervalued. It's trading in the $32 range, and we feel that fair value is at about $38. It's got a forward PE ratio of 12. The forward PE on the S&P 500 17. So the valuation metrics are definitely attractive. They continue to increase the dividend. We're looking at a 4% yield now. And when you look at the performance of different sectors after a Fed rate hike, the best performing sectors in the 24 months following a Fed rate hike are the defensive sectors, not the cyclicals. The number one performing sector would be the consumer staple sector. Healthcare is the number two performing sector in the 24 months after that Fed rate hike. We like Pfizer. We think that while a lot of the big pharma companies have had some innovation problems, when you can't innovate, sometimes you need to buy innovation. So their growth by acquisition strategy seems to be working pretty well for them, and they do have some good products in the pipeline right now as well. So we think Pfizer's a buy.
Okay, Pfizer getting a little bit of love from Mark Tepper, Strategic Wealth Partners, Craig Johnson of Piper Jaffray. Guys, thank you both very much.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.